Introduction to Business, 2nd edition, an OpenStax textbook. Read along with the full text at openstax.org. This audiobook was produced by Open Audio. Listen for free on Spotify, YouTube, Apple Podcasts, or on our website at openaudio.us.
Chapter 15. Understanding Money and Financial Institutions. Introduction.
Learning Outcomes. After reading this chapter, you should be able to answer these questions. 1. What is money? What are its characteristics and functions? And what are the 3 parts of the U.S. money supply? 2. How does the Federal Reserve manage the money supply? 3. What are the key financial institutions, and what role do they play in the process of financial intermediation? 4. How does the Federal Deposit Insurance Corporation, FDIC, protect depositors' funds? 5. What roles do U.S. banks play in the international marketplace? 6. What trends are reshaping financial institutions?
Exploring Business Careers. Michelle Moore, Bank of America. Technology continues to change every facet of daily life, including how consumers interact with banks and other financial institutions. Whether large or small, banks have to stay one step ahead of the competition when it comes to providing top-notch service to their customers, including digital and mobile channels. Michelle Moore, former head of digital banking at Bank of America, and now EVP of Digital, Data, and AI at Wells Fargo, has worked in various parts of the company for more than 14 years. Regardless of her role within the organization, Moore has consistently demonstrated her obsession with exceptional service and how best to make sure the bank is providing customers with products and features that will make their lives easier, keep them loyal to the organization, and ultimately increase sales. While overseeing the bank's call center operations, Moore was asked to take on the bank's mobile initiatives, a request that befuddled her. Moore is the first to tell you she is no techie. She admits she kept her beloved flip phone too long before opting for a smartphone. Yet, her people skills and her drive to provide the best customer service made her the perfect person to take on the bank's digital and mobile efforts. Like other major financial institutions, Bank of America did not have a stellar reputation when it came to digital or mobile banking. Although customers used the bank's digital offerings, the services were basic, even as the smartphone revolution changed many of life's daily activities. Once Moore and her digital team got the bank's mobile app up to speed, they began to figure out how to make it better. The team started to add features to the app, making sure that nearly everything customers can do at a bank branch they can do on the new and improved app. In addition, Moore and her group created a digital assistant feature that uses artificial intelligence and predictive analytics to provide customers with the same level of advice and expertise that previously would have been reserved for customers with high-end wealth management accounts. A play on the word America, the app called Erica debuted to the public in 2018, and customer reaction has been positive. But Moore is never satisfied with the status quo. She encourages her team to constantly ask how customers will use the app and what will it take to make and keep them happy with the digital assistant's features. For example, after Moore read an article on the success of Apple's Siri and Amazon's Alexa, she wondered, why can't our banking app talk to clients? She pushed her team to add a voice feature to Erica, which gave the digital assistant a competitive edge over other banking mobile apps at the time. Moore knows that customer sentiment is critical to the bank's success, especially in mobile banking. She continues to be obsessed by customer reviews and how the bank can increase customer satisfaction quickly and efficiently. And she knows that agility is critical in an ever-changing bank environment. Her efforts are paying off. When entering the mobile banking era, Bank of America had 6 million mobile banking users. Today, that number has jumped to about 30 million. Mobile banking customers logged into their accounts nearly 15 billion times in 2025, representing a 16% increase over the previous year, much more than the number of desktop logins. And when customers need to visit a local bank branch, they are often booking appointments via the mobile app. Although she knows there is more work to do, Moore's common-sense approach to listening to customers while leveraging technology has helped Bank of America increase sales and stay ahead of the competition.
Advanced technology, globalization of markets, and the relaxation of regulatory restrictions continue to accelerate the pace of change in the financial services industry. These changes are giving businesses and consumers new options for conducting their financial transactions. The competitive landscape for financial institutions is also changing, creating new ways for these firms to increase their market share and boost profits. This chapter focuses on the role of financial institutions in US and international economies. It discusses different types of financial institutions, how they are set up, and how they function internally, and government oversight of their operations. Because financial institutions connect people with money, this chapter begins with the discussion of money, its characteristics and functions, and the components of the US money supply. Next, it explains the role of the Federal Reserve System in managing the money supply. Then, it describes different types of financial institutions and their services and the organizations that ensure customer deposits. The chapter ends with a discussion of international banking and trends in financial institutions.
.1 Show me the money. Learning objective. What is money? What are its characteristics and functions? And what are the three parts of the U.S. money supply?
Money is anything that is acceptable as payment for goods and services. It affects our lives in many ways. We earn it, spend it, save it, invest it, making decisions on how to best plan for the future. Businesses and government use money in similar ways. Both require money to finance their operations. By controlling the amount of money in circulation, the federal government can promote economic growth and stability. For this reason, money has been called the oil that keeps our economic system running smoothly. Our banking system was developed to ease the handling of money. Characteristics of money. For money to be a suitable means of exchange, it should have these key characteristics. Scarcity. Money should be scarce enough to have some value, but not so scarce as to be unavailable. Small rocks as currency, for example, which meet some of the other criteria, would not work well as money because they are widely available. Too much money in circulation increases prices and inflation. Governments control the scarcity of money by limiting the quantity of money in circulation. Durability. Any item used as money must be durable. A perishable item such as a fruit or vegetable becomes useless as money when it spoils. Even early societies used durable forms of money, such as metal coins and paper money, which lasted for a long time. Portability. Money must be easily moved around. Large or bulky items, such as heavy rocks or heavy pieces of metal, cannot be transported easily from place to place. Divisibility. Money must be capable of being divided into smaller parts. Divisible forms of money help make transactions of all sizes and amounts possible. Table 15.1 provides some interesting facts about our money. Functions of money. Using a variety of items as money would be confusing. Thus, societies develop a uniform money system to measure the value of goods and services. For money to be acceptable, it must function as a medium of exchange, as a standard of value, and as a store of value. As a medium of exchange, money makes transactions easier. Having a common form of payment is much less complicated than having a barter system, wherein goods and services are exchanged for other goods and services. Money allows the exchange of products to be a consistent and manageable process. Money also serves as a standard of value. With a form of money whose value is accepted by all, goods and services can be priced in standard units. This makes it easy to measure the value of products and allows transactions to be recorded in consistent terms. As a store of value, money is used to hold wealth. It retains its value over time, although it may lose some of its purchasing power due to inflation. Individuals may choose to keep their money for future use, rather than exchange it today for other types of products or assets.
Table 15.1 Interesting facts about U.S. currency. Did you know Currency paper is composed of 25% linen and 75% cotton. About 4,000 double folds, first forward and then backwards, are required before a note will tear. As of December 2024, there was over $2.3 trillion in U.S. currency in circulation. Over 70% of the notes printed each year are used to replace notes already in circulation. The largest note ever printed by the Bureau of Engraving and Printing was the $100,000 gold certificate, Series 1934. During fiscal year 2025, it cost between 4.1 and 7.3 cents to produce the main U.S. bills in circulation. A stack of currency 1 mile high would contain over 14 million notes. If you had 10 billion $1 notes and spent one every second of every day, it would require 317 years for you to go broke.
The U.S. money supply. The U.S. money supply is composed of currency, demand deposits, and time deposits. Currency is cash held in the form of coins and paper money. Other forms of currency include traveler's checks, cashier's checks, and money orders. The amount of currency in circulation depends on public demand. Domestic demand is influenced primarily by prices for goods and services, income levels, and the availability of alternative payment methods such as credit cards. Until the mid-1980s, nearly all U.S. currency circulated only domestically. Today, domestic circulation totals less than half of the total amount of U.S. currency in circulation. Over the past decade, the amount of U.S. currency has grown to over $2.3 trillion and is held both inside and outside the country. Foreign demand is influenced by the political and economic uncertainties associated with some foreign currencies, and estimates suggest that over half of the value of currency in circulation is held abroad. Some residents of foreign countries hold dollars as a store of value, whereas others use it as a medium of exchange. Federal Reserve notes make up more than 99% of all U.S. currency in circulation. Each year, the Federal Reserve Board determines new currency demand and submits a print order to the Treasury's Bureau of Engraving and Printing, BEP. The order represents the Federal Reserve System's estimate of the amount of currency the public will need in the upcoming year and reflects estimated changes in currency usage and destruction rates of unfit currency. Table 15.2 shows how long we can expect our money to last on average.
Table 15.2. How long will your money last? Have you ever wondered how quickly money wears out from being handled or damaged? Not surprisingly, smaller denominations generally have a shorter lifespan. Looking at the lifespans of U.S. currency by bill value, a $1 bill lasts an average of 7.2 years. A $5 bill stays in circulation for 5.8 years. A $10 bill lasts 5.7 years. A $20 bill has a lifespan of 11.1 years. A $50 bill lasts 14.9 years. And a $100 bill remains in circulation the longest, at 24 years.
Demand deposits consist of money kept in checking accounts that can be withdrawn by depositors on demand. Demand deposits include regular checking accounts, as well as interest-bearing and other special types of checking accounts. Time deposits are deposits at a bank or other financial institution that pay interest but cannot be withdrawn on demand. Examples are certain savings accounts, money market deposit accounts, and certificates of deposit. Economists use two terms to report on and discuss trends in the U.S. monetary system: M1 and M2. M1, the M stands for money, is used to describe the total amount of readily available money in the system and includes currency and demand deposits. As of December 2025, the M1 monetary supply was $19.1 trillion. M2 includes all of M1 plus time deposits and other money that is not immediately accessible. At the end of 2025, the M2 monetary supply was $22.4 trillion. Credit cards, sometimes referred to as plastic money, are routinely used as a substitute for cash and checks. Credit cards are not money. They are a form of borrowing. When a bank issues a credit card to a consumer, it gives a short-term loan to the consumer by directly paying the seller for the consumer's purchases. The consumer pays the credit card company after receiving the monthly statement. Credit cards do not replace money. They simply defer payment.
Concept check. 1. What is money and what are its characteristics? 2. What are the main functions of money? 3. What are the three main components of the U.S. money supply? How do they relate to M1 and M2?
$15.2. The Federal Reserve System. Learning objective. How does the Federal Reserve manage the money supply?
Before the 20th century, there was very little government regulation of the U.S. financial or monetary systems. In 1907, however, several large banks failed, creating a public panic that led worried depositors to withdraw their money from other banks. Soon, many other banks had failed, and the U.S. banking system was near collapse. The panic of 1907 was so severe that Congress created the Federal Reserve System in 1913 to provide the nation with a more stable monetary and banking system. The Federal Reserve System, commonly called the Fed, is the central bank of the United States. The Fed's primary mission is to oversee the nation's monetary and credit system and to support the ongoing operation of America's private banking system. The Fed's actions affect the interest rates banks charge businesses and consumers, help keep inflation under control, and ultimately stabilize the U.S. financial system. The Fed operates as an independent government entity. It derives its authority from Congress, but its decisions do not have to be approved by the President, Congress, or any other government branch. However, Congress does periodically review the Fed's activities, and the Fed must work within the economic framework established by the government. The Fed consists of 12 district banks, each covering a specific geographic area. Exhibit 15.3 shows the 12 districts of the Federal Reserve. Each district has its own bank president who oversees operations within that district. Originally, the Federal Reserve System was created to control the money supply, act as a borrowing source for banks, hold the deposits of member banks, and supervise banking practices. Its activities have since broadened, making it the most powerful financial institution in the United States. Today, 4 of the Federal Reserve System's most important responsibilities are carrying out monetary policy, setting rules on credit, distributing currency, and overseeing payment systems, including digital transactions. Carrying out monetary policy. The most important function of the Federal Reserve System is carrying out monetary policy. The Federal Open Market Committee, FOMC, is the Fed policymaking body that typically meets 8 times a year to make monetary policy decisions. It uses its power to change the money supply in order to control inflation and interest rates, increase employment, and influence economic activity. 3 tools used by the Federal Reserve System in managing the money supply are open market operations, reserve requirements, and the discount rate. Table 15.3 summarizes the short-term effects of these tools on the economy. Open market operations, a key function of the Federal Reserve, involve the purchase or sale of U.S. government bonds. The U.S. Treasury issues bonds to obtain the extra money needed to run the government, if taxes and other revenues aren't enough. In effect, Treasury bonds are long-term loans, 20 to 30 years, made by businesses and individuals to the government. The Federal Reserve buys and sells these bonds for the Treasury. When the Federal Reserve buys bonds, it puts money into the economy. Banks have more money to lend, so they reduce interest rates, which generally stimulates economic activity. The opposite occurs when the Federal Reserve sells government bonds.
Table 15.3. The Federal Reserve System's monetary tools and their effects. This table breaks down how specific actions taken by the Federal Reserve influence the broader economy by impacting the money supply, interest rates, and overall economic activity. Looking first at open market operations. When the Federal Reserve buys government bonds, it increases the money supply, lowers interest rates, and stimulates economic activity. Conversely, when the Fed sells government bonds, it decreases the money supply, raises interest rates, and slows down economic activity. Next, looking at the discount rate. If the Fed chooses to raise the discount rate, this decreases the money supply, raises interest rates, and slows down economic activity. On the other hand, if the Fed chooses to lower the discount rate, this increases the money supply, lowers interest rates, and stimulates economic activity.
The Federal Reserve is called the banker's bank because it lends money to banks that need it. The interest rate that the Federal Reserve charges its member banks is called the discount rate. When the discount rate is less than the cost of other sources of funds, such as certificates of deposit, commercial banks borrow from the Federal Reserve and then lend the funds at a higher rate to customers. The banks profit from the spread, or difference, between the rate they charge their customers and the rate paid to the Federal Reserve. Changes in the discount rate usually produce changes in the interest rate that banks charge their customers. The Federal Reserve raises the discount rate to slow down economic growth and lowers it to stimulate growth. Setting rules on credit. Another activity of the Federal Reserve System is setting rules on credit. It controls the credit terms on some loans made by banks and other lending institutions. This power, called selective credit controls, includes consumer credit rules and margin requirements. Consumer credit rules establish the minimum down payments and maximum repayment periods for consumer loans. The Federal Reserve uses credit rules to slow or stimulate consumer credit purchases. Margin requirements specify the minimum amount of cash an investor must put up to buy securities or investment certificates issued by corporations or governments. The balance of the purchase cost can be financed through borrowing from a bank or brokerage firm. By lowering the margin requirement, the Federal Reserve stimulates securities trading. Raising the margin requirement slows trading. Distributing currency, keeping the cash flowing. The Federal Reserve distributes the coins minted and the paper money printed by the U.S. Treasury to banks. Most paper money is in the form of Federal Reserve notes. Look at a dollar bill and you'll see Federal Reserve note at the top. The large letter seal on the left indicates which Federal Reserve Bank issued it. For example, bills bearing a D seal are issued by the Federal Reserve Bank of Cleveland, and those with an L seal are issued by the San Francisco District Bank. Making check clearing easier. Another important activity of the Federal Reserve is processing and clearing checks between financial institutions. When a check is cashed at a financial institution other than the one holding the account on which the check is drawn, the Federal Reserve System lets that financial institution, even if distant from the institution holding the account on which the check is drawn, quickly convert the check into cash. Transactions, through various means such as checks or ACH, drawn on banks within the same Federal Reserve District, are handled through the local Federal Reserve Bank using a series of entries, often electronic, to transfer funds between the financial institutions. The process is more complex for transactions between different Federal Reserve districts. The time between when the transaction is initiated and when the funds are deducted from the originator's account provides float. With ACH transactions, the float is greatly reduced, almost instantaneous, from what you would expect with a paper check. Float benefits the originator by allowing it to retain the funds until the transaction clears. That is, when the funds are actually withdrawn from its accounts. Check usage declined over the last decade from 6% to just 2.5% of customer transactions. It is projected that the number of check payments will continue to decline as more people exclusively use online banking and other electronic payment systems. In fact, some countries are planning to phase out checks in the coming years entirely, and the U.S. government no longer accepts or issues checks for items such as tax payments or Social Security benefits as of September 2025. Managing the Great Recession. Much has been written about the global financial crisis that occurred between 2007 and 2009. Some suggest that without the Fed's intervention, the US economy would have slipped deeper into a financial depression that could have lasted years. The Great Recession was caused by several factors, including weak regulation of the mortgage market, lenders taking excess risk, and lending practices that put borrowers at risk of default. These actions, along with other economic factors, put the US economy into a financial crisis. In the early 2000s, the housing industry was booming. Mortgage lenders were signing up consumers for mortgages that, on paper, they could afford. In many instances, lenders told consumers that based on their credit rating and other financial data, they could easily take the next step and buy a bigger house or maybe a vacation home because of the availability of mortgage money and low interest rates. This prompted a situation in which borrowers could no longer afford to pay their mortgages, and they started to default on their home loans in late 2007. The value of real estate declined, and many borrowers owed more on their loans than the home was worth, which left their investment underwater. Many consumers were unable to keep their homes and even had to file for personal bankruptcy. At the same time, the US economy was struggling, and unemployment was on the rise as companies were responding to the declining economic conditions. In addition, several leading financial investment firms, particularly those that managed and sold the high-risk, mortgage-backed financial products, failed quickly because they had not set aside enough money to cover the billions of dollars they lost on mortgages, then going into default. For example, Bear Stearns, a large investment bank in operation since 1923, had a large portion of investments that were secured by mortgages that were going unpaid by consumers. The firm could not survive the impact and was sold to JP Morgan Chase for less than $10 per share in 2008. After the collapse of Bear Stearns and other firms such as Countrywide Financial and Merrill Lynch, the Fed set up a special loan program to stabilize the banking system and to keep the US bond markets trading at a normal pace. The Federal Reserve made more than $9 trillion in loans to financial firms during the Great Recession. Additionally, the Federal Reserve provided emergency funding for firms in the auto industry as a bailout to help support the US stock market. As a result of this financial meltdown, Congress passed legislation in the years that followed to establish more regulations in the financial industry, both to protect consumers and to help prevent another recession because of risky lending practices. Among its provisions, the Dodd-Frank Wall Street Reform and Consumer Protection Act, known as Dodd-Frank, created oversight councils to track the stability of major firms in the financial industry and regulate insurance companies. The councils were given the powers to require changes, liquidate, or restructure the firms to protect the stability of the US economy. Risky investments by financial firms are now also restricted. Consumers are more protected as a result of the Act with the Consumer Financial Protection Bureau. Finally, the Act established a whistleblower provision to protect individuals who come forward to report security and financial violations. Another provision of Dodd-Frank legislation requires major U.S. banks to submit to annual stress tests conducted by the Federal Reserve. These annual checkups determine whether banks have enough capital to survive economic turbulence in the financial system, and whether the institutions can identify and measure risk as part of their capital plan to pay dividends or buy back shares. And today, this has grown to all banks. Although the number of banks required to meet the standards was decreased in 2018 with the passing of the Economic Growth, Regulatory Relief, and Consumer Protection Act.
Concept check. 1. What are the 4 key functions of the Federal Reserve System? 2. What 3 tools does the Federal Reserve System use to manage the money supply, and how does each affect economic activity? 3. What was the Fed's role in supporting the U.S. financial markets to recovery during the Great Recession?
.3 U.S. financial institutions. Learning objective. What are the key financial institutions, and what role do they play in the process of financial intermediation?
The well-developed financial system in the United States supports our high standard of living. The system allows those who wish to borrow money to do so with relative ease. It also gives savers a variety of ways to earn interest on their savings. For example, a small business wants to build a new facility in Atlanta. They would like to take out a loan from a financial institution to finance the new facility. The financial institution also has customers in San Diego with savings accounts. The institution can use the savings funds to give the loan to the business in Atlanta. The interest paid on the loan covers the costs to the bank for providing the funding, and also allows the bank to give interest to the customers with savings accounts, and for the bank to make a profit. The transfer of funds from savers to investors enables businesses to expand and the economy to grow. Households are important participants in the U.S. financial system. Although many households borrow money to finance purchases, they supply funds to the financial system through their purchases and savings. Overall, businesses and governments are users of funds. They borrow more money than they save. Sometimes, those who have funds deal directly with those who want them. A family member may have the ability to lend money to another family member to purchase a house. Most often, financial institutions act as intermediaries, or go-betweens, between the suppliers and demanders of funds. The institutions accept savers' deposits and invest them in financial products, such as loans, that are expected to produce a return. This process, called financial intermediation, is shown in Exhibit 15.5. Households are shown as suppliers of funds, and businesses and governments are shown as demanders. However, a single household, business, or government can be either a supplier or a demander, depending on the circumstances. Financial institutions are the heart of the financial system. They are convenient vehicles for financial intermediation. They can be divided into two broad groups: depository institutions, those that accept deposits, and non-depository institutions, those that do not accept deposits.
Exhibit 15.5. The financial intermediation process. This diagram illustrates how money flows through financial institutions to connect those who save money with those who need to borrow it. The financial intermediation process links two primary groups through a central network of institutions. On one side are the suppliers of funds, primarily represented by households. Individuals save and invest their money using vehicles like bank accounts, life insurance policies, and retirement funds. In the middle stand the financial intermediaries. These institutions accept those funds and include commercial banks, savings and loan associations, savings banks, credit unions, life insurance companies, and pension funds. These intermediaries convert those accumulated resources into financial instruments like loans and securities. Finally, on the other side are the demanders of funds, which consist of businesses and governments. They borrow this capital from the intermediaries to finance operations, expansion, and public projects.
Depository financial institutions. Not all depository financial institutions are alike. Most people call the place where they save their money a bank. Some of those places are indeed banks, but other depository institutions include thrift institutions and credit unions. Commercial banks. A commercial bank is a profit-oriented financial institution that accepts deposits, makes business and consumer loans, invests in government and corporate securities, and provides other financial services. Commercial banks vary greatly in size, from the money center banks located in the nation's financial centers to smaller regional and local community banks. As a result of consolidations, small banks are decreasing in number. There are approximately 3,900 commercial banks in the United States, accounting for $24.5 trillion in assets. Banks hold a variety of assets, as shown in the diagram in Exhibit 15.6. Table 15.4 lists the top 10 insured U.S.-chartered commercial banks based on their consolidated assets.
Exhibit 15.6. Assets of FDIC-insured commercial banks, 2026. This pie chart provides a breakdown of how FDIC-insured commercial banks allocate their assets across three primary categories. The majority of bank assets are held in loans and leases, which make up the largest segment at 54.8%. The remaining assets are nearly evenly split between the other two categories. Cash, federal funds, and other assets account for 23.2% of the total, while securities comprise 23%.
Customers' deposits are a commercial bank's major source of funds, the main use for which is loans. The difference between the interest the bank earns on loans and the interest it pays on deposits, plus fees it earns from other financial services, pays the bank's costs and provides a profit. Commercial banks are corporations owned and operated by individuals or other corporations. They can be either national or state banks, and to do business, they must get a bank charter, an operating license, from a state or federal government. National banks are chartered by the Comptroller of the Currency, who is part of the U.S. Treasury Department. These banks must belong to the Federal Reserve System and must carry insurance on their deposits from the Federal Deposit Insurance Corporation. State banks are chartered by the state in which they are based. Generally, state banks are smaller than national banks, are less closely regulated than national banks, and are not required to belong to the Federal Reserve System. Thrift institutions. A thrift institution is a depository institution formed specifically to encourage household saving and to make home mortgage loans. Thrift institutions include savings and loan associations, S&Ls, and savings banks. S&Ls keep large percentages of their assets in home mortgages. Compared with S&Ls, savings banks focus less on mortgage loans and more on stock and bond investments. Thrifts are declining in number. At their peak in the late 1960s, there were more than 4,800, but a combination of factors, including sharp increases in interest rates in the late 1970s and increased loan defaults during the recession of the early 1980s, has reduced their ranks significantly. In 2020, due to acquisitions by or conversions to commercial banks or other savings banks, the number of thrifts had fallen to just over 600.
Table 15.4. Top 10 insured U.S. chartered commercial banks based on total assets 2026. This table lists the 10 largest U.S. commercial banks ranked by total assets. At the top of the list, JP Morgan Chase Bank leads with over $3.8 trillion in total assets. Bank of America holds the second position with approximately $2.65 trillion, followed by Citibank at $1.84 trillion, and Wells Fargo Bank at $1.77 trillion. Rounding out the remaining top 10 in order are U.S. Bank at roughly $679 billion, Capital One at $652 billion, Goldman Sachs Bank at $644 billion, PNC Bank at $564 billion, Truist Bank at $535 billion, and the Bank of New York Mellon at $366 billion.
Customer satisfaction and quality. Rating banks. Mobile and branch banking a must. Which banks provide the best customer satisfaction? J.D. Power, JDP, based in Costa Mesa, California, ranked 9 national banks in the United States based on responses from more than 11,500 retail banking customers. In the research company's 2025 study, top performers received high ratings in Trust People, account offerings, allowing customers to bank how and when they want, saving time and money, digital channels, and resolving problems or complaints. While specific banks took the top spots in various areas of the country, the overall customer sentiment in the JDP survey was clear. Consumers want banks that offer a digital experience and, as needed, personal interaction at a local branch. Findings also suggest that banks that provide a user-friendly digital experience will have higher customer satisfaction. This is especially important as customers utilize the full range of banking services, such as mortgages and wealth management products. Other key survey findings include: overall satisfaction increased 8 points over 2024's score. Credit unions scored, on average, 74 points higher on satisfaction than banks. Customers better understand the fees assessed, with 1/3 of credit union customers under 40 years of age indicating they are going to close their accounts because of fees. Customers indicated more confidence in banks supporting them during hard times. Fraud, debit cards, and interest earned on deposits were noted as areas of improvement. Assessing customer satisfaction is also the goal of the American Customer Satisfaction Index, ACSI, which granted Bank of America the top spot in the national bank category in its 2025 survey, with a 1% decline in its overall score. Other top super-regional banks in the ACSI study include Regions Bank, TD Bank, PNC Bank, and Capital One. Overall, national banks' customer service experience declined 1% from ACSI's previous survey. Critical thinking questions. 1. What can banks and financial institutions do to retain their customers and make them feel valued? 2. Is there a cost involved in not making customer service a priority? Explain your answer.
Credit unions. A credit union is a not-for-profit, member-owned financial cooperative. Credit union members typically have something in common. They may, for example, work for the same employer, belong to the same union or professional group, or attend the same church or school. The credit union pools their assets or savings in order to make loans and offer other services to members. The not-for-profit status of credit unions makes them tax-exempt, so they can pay good interest rates on deposits and offer loans at favorable interest rates. Like banks, credit unions can have either a state or federal charter. The approximately 4,300 credit unions in the United States have more than 143 million members and over $2.3 trillion in assets. The 5 largest credit unions in the United States are shown in Table 15.5. Although the U.S. credit union system remained strong during the 2007 to 2009 financial crisis, consumer-owned credit unions in several regions weakened as a result of home foreclosures, business failures, and unemployment rates. Today, the credit union system demonstrates resilience because of its member-oriented structure and greater stability with lower risk. Services offered. Commercial banks, thrift institutions, and credit unions offer a wide range of financial services for businesses and consumers. Typical services offered by depository financial institutions are listed in Table 15.6. Some financial institutions specialize in providing financial services to a particular type of customer, such as consumer banking services or business banking services.
Managing change. Banks take on P2P payments. Person-to-person, P2P, payment systems are big business, and U.S. banks are now working together to compete in this billion-dollar industry. P2P transfers made through apps such as Venmo, PayPal, Cash App, and others globally accounted for nearly $6 billion in 2023, with expected growth to over $30 billion by 2032. The simplicity of P2P apps has made them a part of everyday life for millions, especially millennials and young adults who use their smartphones for many daily activities. Venmo, for example, requires a phone number and a bank account, or debit card. You must also be at least 18 years of age and be located in the United States. Social media sites also encourage their members to transfer money via mobile apps, such as Google Wallet and Facebook Messenger. Banks have been successful allowing their own customers to transfer money via apps. However, P2P transfers have been limited to other customers of the same bank. Until now, more than 1,600 financial institutions utilize Zelle, which can be used to transfer funds to customers across these banking institutions. Over 80% of people in the United States can connect to Zelle via their bank's app. A downside of using Venmo is that it may take a day or two for money to arrive in a recipient's account because the money flows through an intermediary. However, for a fee, you can get the funds instantly. With Zelle, for enrolled users, the transfer of money between two accounts will occur within minutes. Typically, customers using Zelle through their banks are not charged a fee to accept or send money. Is a cashless society imminent now that major banks have gotten on board with P2P payments? Probably not, but the Consumer Financial Protection Bureau has put rules in place to protect customers. As of the end of 2024, P2P systems will be supervised in the same way that banks and credit unions are. This oversight includes document reviews and employee interviews to make sure they are maintaining consumer privacy and protecting against fraudulent activities. Critical thinking questions. 1. Does working together on a P2P system help banks stay competitive? Explain your reasoning. 2. Do you think P2P payment systems will eventually eliminate the use of cash in our society? Why or why not?
Table 15.5. 5 largest U.S. credit unions. This table ranks the 5 largest credit unions in the United States along with their headquarters locations. Navy Federal Credit Union, based in Vienna, Virginia, holds the top position. State Employees Credit Union follows, located in Raleigh, North Carolina. Schools First Federal Credit Union sits in the 3rd spot, based in Santa Ana, California. PenFed Credit Union comes next, headquartered in Alexandria, Virginia. And rounding out the top 5 is Boeing Employees Credit Union, located in Tukwila, Washington.
Non-depository financial institutions. Some financial institutions provide certain banking services but do not accept deposits. These non-depository financial institutions include insurance companies, pension funds, brokerage firms, and finance companies. They serve both individuals and businesses. Insurance companies. Insurance companies are major suppliers of funds. Policyholders make payments, called premiums, to buy financial protection from the insurance company. Insurance companies invest the premiums in stocks, bonds, real estate, business loans, and real estate loans for large projects.
Table 15.6. Services offered by depository financial institutions. This table outlines various financial services along with descriptions of how each operates. Savings accounts are deposits that gain interest, with the expectation that the money will remain in the account for some time. Checking accounts are transactional accounts, where depositors can deposit or withdraw funds at any time up to the amount in the account. Money market deposit accounts have features of both a savings and checking account, offering higher interest rates based on market rates.
Certificates of deposit, or CDs, are similar to savings accounts, but they pay a fixed interest rate over a certain time period during which you cannot withdraw the funds. Consumer loans are made to individuals to finance purchases such as homes or cars. Business loans are provided to businesses or organizations to finance their operations. Electronic funds transfer involves the use of computers and mobile devices to conduct financial transactions. An automated teller machine, or ATM, is a self-service kiosk where customers can conduct a variety of transactions, including withdrawals and deposits.
Debit cards enable the electronic transfer of funds from a checking or savings account to be used for purchases. Online banking allows customers to conduct financial transactions online or via a mobile app. Mobile apps provide technology that allows consumers to download programs to mobile devices that enable them to take care of banking, financial, and other transactions. Direct deposit of paychecks is enabled through employers and payroll service vendors, allowing financial institutions to accept direct deposits of payroll checks to consumers' checking or savings accounts on a regular basis.
Pension funds. Corporations, unions, and governments set aside large pools of money for later use in paying retirement benefits to their employees or members. These pension funds are managed by the employers or unions themselves, or by outside managers such as life insurance firms, commercial banks, and private investment firms. Pension plan members receive a specified monthly payment when they reach a given age. After setting aside enough money to pay near-term benefits, pension funds invest the rest in business loans, stocks, bonds, or real estate. They often invest large sums in the stock of the employer. U.S. pension fund assets total nearly $30 trillion. Brokerage firms. A brokerage firm buys and sells securities, stocks, and bonds for its clients and gives them related advice. Many brokerage firms offer some banking services. They may offer clients a combined checking and savings account with a high interest rate and also make loans backed by securities to them. Finance companies. A finance company makes short-term loans for which the borrower puts up tangible assets, such as an automobile, inventory, machinery, or property. As security, finance companies often make loans to individuals or businesses that cannot get credit elsewhere, promising new businesses with no track record, and firms that can't get more credit from a bank often obtain loans from commercial finance companies. Consumer finance companies make loans to individuals, often to cover the lease or purchase of large consumer goods, such as automobiles or major household appliances. To compensate for the extra risk, finance companies usually charge higher interest rates than banks.
Concept check. 1. What is the financial intermediation process? 2. Differentiate between the three types of depository financial institutions and the services they offer. 3. What are the four main types of non-depository financial institutions?
$15.4. Insuring bank deposits. Learning objective. How does the Federal Deposit Insurance Corporation, FDIC, protect depositors' funds?
The U.S. banking system worked fairly well from when the Federal Reserve System was established in 1913 until the stock market crash of 1929 and the Great Depression that followed. Business failures caused by these events resulted in major cash shortages as people rushed to withdraw their money from banks. Many cash-starved banks failed because the Federal Reserve did not, as expected, lend money to them. The government's efforts to prevent bank failures were ineffective. Over the next 2 years, 5,000 banks, about 20% of the total number, failed. President Franklin D. Roosevelt made strengthening the banking system his first priority. After taking office in 1933, Roosevelt declared a bank holiday, closing all banks for a week so he could take corrective action. Congress passed the Banking Act of 1933, which empowered the Federal Reserve System to regulate banks and reform the banking system. The Act's most important provision was the creation of the Federal Deposit Insurance Corporation, FDIC, to insure deposits in commercial banks. The 1933 Act also gave the Federal Reserve authority to set reserve requirements, ban interest on demand deposits, regulate the interest rates on time deposits, and prohibit banks from investing in specified types of securities. In 1934, the Federal Savings and Loan Insurance Corporation, FSLIC, was formed to insure deposits at S&Ls. When the FSLIC went bankrupt in the 1980s, the FDIC took over responsibility for administering the fund that insures deposits at thrift institutions. Today, the major deposit insurance funds include the following. The Deposit Insurance Fund, DIF. Administered by the FDIC, this fund provides deposit insurance to commercial banks and thrift institutions. The National Credit Union Share Insurance Fund. Administered by the National Credit Union Administration, this fund provides deposit insurance to credit unions. Role of the FDIC. The FDIC is an independent, quasi-public corporation backed by the full faith and credit of the U.S. government. It examines and supervises over 4,300 banks and savings banks, more than half the institutions in the banking system. It insures trillions of dollars of deposits in U.S. banks and thrift institutions against loss if the financial institution fails. The FDIC insures all member banks in the Federal Reserve System. The ceiling on insured deposits is $250,000 per account. Each insured bank pays the insurance premiums, which are a fixed percentage of the bank's domestic deposits. In 1993, The FDIC switched from a flat rate for deposit insurance to a risk-based premium system because of the large number of bank and thrift failures during the 1980s and early 1990s. Some experts argue that certain banks take too much risk because they view deposit insurance as a safety net for their depositors, a view many believe contributed to earlier bank failures. Enforcement by the FDIC. To ensure that banks operate fairly and profitably, the FDIC sets guidelines for banks and then reviews the financial records and management practices of member banks at least once a year. Bank examiners perform these reviews during unannounced visits, rating banks on their compliance with banking regulations. For example, the Equal Credit Opportunity Act, which states that a bank cannot refuse to lend money to people because of their color, religion, or national origin. Examiners also rate a bank's overall financial condition, focusing on loan quality, management practices, earnings, liquidity, and whether the bank has enough capital, equity, to safely support its activities. When bank examiners conclude that a bank has serious financial problems, the FDIC can take several actions. It can lend money to the bank, recommend that the bank merge with a stronger bank, require the bank to use new management practices, or replace its managers, buy loans from the bank, or provide extra equity capital to the bank. The FDIC may even cover all deposits at a troubled bank, including those over $250,000, to restore the public's confidence in the financial system.
Concept check. 1. What is the FDIC and what are its responsibilities? 2. What are the major deposit insurance funds? 3. What can the FDIC do to help financially troubled banks?
.5 International banking. Learning objective. What roles do U.S. banks play in the international marketplace?
The financial marketplace spans the globe, with money routinely flowing across international borders. U.S. banks play an important role in global business by providing loans to foreign governments and businesses. Multinational corporations need many special banking services, such as foreign currency exchange and funding for overseas investments. U.S. banks also offer trade-related services, such as global cash management, that help firms manage their cash flows, improve their payment efficiency, and reduce their exposure to operational risks. Sometimes consumers in other nations have a need for banking services that banks in their own countries don't provide. Therefore, large banks often look beyond their national borders for profitable banking opportunities. Many U.S. banks have offices across the world. They can have additional services and access to more sources of funding. Citibank, for example, was the first bank to enter the existing Japanese ATM network, providing direct competition to the domestic Japanese banks. For U.S. banks, expanding internationally can be difficult. Banks in other nations might be subject to fewer regulations than U.S. banks, making it easier for them to undercut American banks on the pricing of loans and services. Some governments also protect their banks against foreign competition. For example, China imposes higher fees and may limit the amount of deposits that foreign banks can accept from customers. Interest rates also vary to place some restrictions on borrowing from foreign banks. International banks operating within the United States also have a substantial impact on the economy through job creation. They employ over 200,000 U.S. citizens as of 2024, operating and capital expenditures, taxes, and other contributions. According to December 2025 Federal Reserve data, the combined banking and non-banking assets of the U.S. operations of foreign banks total more than $3.3 trillion.
Table 15.7. The world's biggest banks, 2026. This table highlights the world's largest banks, ordered by scale. Chinese institutions dominate the top spot, led by Industrial and Commercial Bank of China, China Agricultural Bank, China Construction Bank, and Bank of China. Two major U.S. institutions follow, with J.P. Morgan Chase and Bank of America Corp., representing the United States. European banks hold key positions as well, including HSBC from the United Kingdom, along with BNP Paribas and Crédit Agricole from France. Rounding out the top global banks is Mitsubishi UFJ Financial Group, representing Japan.
The United States has two banks listed in the top 10 world's biggest banks, as shown in Table 15.7. Political and economic uncertainty in other countries can make international banking a high-risk venture. European and Asian banks were not immune to the financial crisis of 2007 to 2009. In fact, several countries, including Greece, Portugal, Spain, and Ireland, have rebounded from the near collapse of their economic and financial systems they experienced at that time. Financial bailouts, spearheaded by the European Union and the International Monetary Fund, have helped stabilize the European and global economy. The impact of Brexit, with the United Kingdom leaving the European Union, affected international banking. Many overseas banks were based in London and utilized the benefits of being part of the EU to have access to the other 27 member countries. With the UK leaving the EU, new authorizations to conduct business in those countries was required. This impacts their businesses today as they try to navigate the additional compliance issues.
Concept check. 1. What is the role of U.S. banks in international banking? 2. What challenges do U.S. banks face in foreign markets?
(15.6) Trends in financial institutions. Learning objective. What trends are reshaping financial institutions?
What factors will influence financial institutions in the coming years? The latest reports suggest there will be a continued focus on regulatory and compliance issues, especially after financial crisis of the Great Recession, as well as on operational efficiency and technological advances. Banks will continue to tackle customer engagement and technology initiatives over the next few years. According to a 2025 report by Evolution Partners, a global consultant firm that forecasts banking trends, technology continues to empower consumers to control their banking experiences. Additionally, the inclusion of AI and cybersecurity concerns are at the forefront in the coming years. The term responsive resilience is identified as a key trend as financial institutions navigate the opportunities and challenges of new technologies and ever-changing regulations. Financial technology, or fintech services, will continue to disrupt the banking industry and provide opportunities for banks and other institutions to work closely with fintech companies that can help them innovate and streamline their business practices. Data indicate that fintech firms are estimated to reach $1.5 trillion in revenues by 2030, which represents 25% of banking across the globe. Services offered by fintech firms include digital payments, P2P lending, online money transfers, and personal finance management. Mobile financial apps will continue to be a strategic advantage that separates traditional banking approaches from innovative companies that can offer their clients a connected, digital experience when it comes to their money and investments. Consumers will expect personalization of bank products and services as part of their routine interaction with financial institutions. Otherwise, they will look elsewhere for a competitive platform to meet all of their financial and banking needs. Many banks continue to offer local branch offices, but online and mobile services will continue to grow in popularity. Most banking institutions offer apps that give customers the convenience of moving money between accounts and mobile check deposits that expedite when money is available in their account. In addition, online payment platforms such as PayPal, Cash App, Square, and Venmo continue to make both personal and business transactions seamless. Customers expect access to banking needs to be quick, efficient, and readily accessible when needed.
Managing change. Chatbots help banks connect with customers. Computer software using artificial intelligence, AI, to simulate conversation with humans Chatbots have become an integral part of the banking industry's push to connect with customers while keeping operations and costs in line. They can be an effective tool in what banks call conversational commerce, interacting with customers via messaging and digital platforms. Typically, banks engage their customers through various channels, including human channels, in-person transactions or service calls, with a live agent, and digital channels, websites, mobile apps, email, and online ads. Although customers may have a favorite way to interact with their bank, these channels can cost banks a substantial amount of money, and financial institutions are constantly looking for ways to reduce costs while maintaining quality customer service. It is not surprising that in-person transactions are the most expensive service provided by banks. However, not every transaction with a customer requires human intervention. As technology continues to evolve, more banks have figured out they can leverage their services to fit the everyday activities of their tech-savvy customers by using chatbots as the next step in customer service. For example, as mentioned in the opening feature in this module, Bank of America introduced Erica, a voice and text-enabled chatbot that helps customers make smarter banking decisions. Erica sends customers notifications, points out areas where they can save money, updates credit ratings, and can help facilitate bill payments within the bank's mobile app. Capital One, another player in the U.S. banking industry, launched Eno, a text-enabled chatbot that helps customers manage their money via smartphone. Customers can ask Eno questions about account balances, credit history, recent transactions, payment history, and so forth via text messaging. Eno is the second virtual assistant created by Capital One. It already has in place Alex Skill, which allows customers to conduct their banking business through voice and conversations with Alexa. AI chatbots provide benefits to both banks and customers. Banks are using them to streamline operations, automate customer support, and provide a convenient and positive customer experience. Customers rely on this type of digital assistant to make their lives easier and keep them current on personal and business transactions, without having to wait on hold for a person to respond to questions that can easily be answered by chatbots. A report by Deloitte in 2025 found that 63% of customers have interacted with banking chatbots. The data collected indicate that more than half of the usage was for technical support, 60%, and inquiries about their accounts, 53%. A large majority, nearly 3/4 of customers, prefer human interaction, even for routine transactions. With nearly 4 billion users of mobile banking worldwide, chatbots can be an effective tool to help banks become more efficient, more proactive in anticipating customer needs, and more sensitive to their bottom line. Critical thinking questions. 1. Do you think chatbots will eventually replace customer service representatives at U.S. banks? Explain your reasoning. 2. What are some advantages and disadvantages of using a digital assistant as part of your banking routine?
Concept check. 1. How will fintech services enhance the overall banking experience? 2. What challenges do banks face when it comes to offering local branch services to customers?
Preparing for tomorrow's workplace skills. 1. How much does a bank account cost? Call or visit websites of several local banks and weigh fees and services. Take into consideration how you will use your account, how many transactions a month you will have, and the average balance you expect to keep. On the internet, Bankrate.com lets you digitally compare bank products, including those banking institutions that are strictly internet-based. Could you pay lower fees elsewhere? Could you earn interest on your checking account at a credit union? Would you be better off paying a monthly fee with unlimited check writing privileges? Crunch the numbers to find the best deal. 2. You are starting a small business selling collectible books over the internet and need to establish a business banking account that will provide the following services: business checking, credit card processing, a business savings account, and perhaps a line of credit. Research at least 3 banks, including an online-only bank, to gather information about their business banking services, including data about fees, service options, and other features of interest to entrepreneurs. Write a short summary of each bank's offerings and benefits, and make a recommendation about which bank you would choose for your new business. 3. If you watch the news, you've undoubtedly heard mention that the Fed is going to raise or lower interest rates. What exactly does this mean? Explain how the Fed's decision to raise and lower its discount rate might affect A. A large manufacturer of household appliances, a mid-sized software firm, a small restaurant, a family hoping to purchase their first home, and E. A college student. 4. Research the banking system of another country and write a report on your findings by answering these questions. Is there a central banking system similar to the U.S. Federal Reserve System in place? Which government agency or department controls it, and how does it operate? How stable is the country's central banking system? How does it compare in structure and operation to the Federal Reserve System? How much control does the government have over banks operating in the country? Are there any barriers to entry specifically facing foreign banks? What would this mean to a foreign business attempting to do business in this country? 5. Banks use databases to identify profitable and unprofitable customers. Data indicate that banks will lose money on customers with balances under $1,000 and those that frequently utilize banking services. The more profitable customers are those that keep several $1,000s in their accounts and have limited usage of banking services. To turn unprofitable customers into profitable ones, banks assess fees on many of their services, but some of the fees are reduced or waived for customers who maintain high account balances. Bankers justify the fees by saying they're in business to earn a profit. Discuss whether banks are justified in treating profitable and unprofitable customers differently. Defend your answers. 6. Team activity. During its regular meetings, the Federal Open Market Committee, the Federal Reserve's monetary policy-making body, considers a number of economic indicators and reports before making decisions. The decisions made by the Fed include whether to sell or purchase federal treasury bonds, whether to raise or lower interest rates, and whether to raise or lower the Federal Reserve discount rate. Divide your class into groups. If possible, try to use 7 members, the size of the FOMC, and assign each group one of these decisions. As a group, identify the types of information used by the Fed in making their assigned decision, and how that information is used. Find the most current information. Sources may include news sites, business publications, online databases, and so forth, and analyze it. Based on this information and your group's analysis, what should the Fed do now? Present your findings and recommendations to the class.
Ethics activity. You are a loan officer with a financial company that specializes in auto loans. The senior vice president in charge of your area sets new loan quotas for your group and suggests that courting more subprime borrowers would make the new quotas easier to meet. They remind you that the company can justifiably charge higher interest rates, loan fees, and servicing costs for these higher risk loans. They also point out that the loans will earn you and your team larger commissions as well. Everyone wins, they tell you. We help people who might otherwise not be able to get the financing they need. The company makes money, and so do you. But you are uneasy about the company's focus on subprime borrowers, low-income applicants with weak or limited credit histories, many of whom are also minorities. You suspect the company's tactics could be considered predatory lending or reverse redlining. You are also convinced that the cost of the company's subprime loans aren't tied to the increased risk factor at all, but to how much profit the company can squeeze from a group of unsophisticated borrowers with few other options. Using a web search tool, locate articles about the topic of subprime auto loans, and then write responses to the following question. Be sure to support your arguments and cite your sources. Ethical dilemma. Should you seek out subprime loans, knowing that you will have to charge borrowers the high fees your company demands, while believing they may not be totally justified?
Critical thinking case. Stripe revolutionizes digital payments. Raised in Ireland, Patrick and John Collison were precocious, inquisitive youngsters who taught themselves computer coding at an early age. By the time they were teenagers, the brothers were developing iPhone apps and eventually became college dropouts after a few semesters at university. Patrick attended MIT and John attended Harvard. During this time, they started a company called Octomatic Inc., which created an online marketplace management system for companies such as eBay, and then sold the company for $5 million in 2008. After selling the business, they continued to work on simplifying the payment process for startup businesses that use the internet to sell goods and services. As the internet entered its second decade and more entrepreneurs were using the web to do business, the Collisons recognized that the payment transaction process for online purchases needed an overhaul. In 2011, they opened their new company, Stripe, after testing their service and building relationships with banks, credit card companies, and regulators, so clients could focus their energies on building their businesses and not building a payment infrastructure from scratch. Using Stripe, businesses only need to add 7 lines of coding to their websites to handle payments, a process that previously could have taken weeks to perfect. Word spread quickly among developers that the Collison brothers' simple coding architecture could indeed disrupt the payment processing industry. As more and more marketplace companies and other online services needed to divvy up payments between vendors and consumers, Stripe became the go-to company to figure out how to move money online quickly and to get people and companies paid. The company's engineers determined how to separate payments for some of the internet's startups, such as Lyft, which needed consumers to pay for rides and drivers to be compensated quickly. Stripe engineers worked their magic to bypass typical banking protocol and linked payments to Lyft drivers via their debit cards, which allowed them to be paid promptly. After over 25 years in business, Stripe is now the financial back office for more than 100,000 businesses that take mobile payments, some of them startups, and some of them big businesses such as Amazon, Microsoft, BMW, and Toyota. The company charges a fee on credit card payments in exchange for its services. Although Stripe's sales data are confidential, the company has a valuation at over $100 billion and handled more than $1.4 trillion in payment volume processing in 2024. With around 8,000 employees, Stripe continues to expand its product offerings in an effort to give customers and potential clients new tools they can use to help grow their business. For example, Radar, Stripe's fraud detection service, uses artificial intelligence to analyze payments on its extensive network to identify suspicious activity. By looking at such a large data set on its own network, Stripe can spot patterns better than a single company reviewing its own transactions. The company has rolled out another tool called Atlas, which can help a local or overseas startup incorporate, get a taxpayer ID number and U.S. bank account, and receive legal and tax advice on forming a company for a fee of $500 and a few simple clicks. Typically, this process would take months, many visits to the United States, if a foreign business, and large legal fees. Stripe continues to disrupt the payment processing industry, and its Irish co-founders believe they have what it takes to continue building a simple internet infrastructure that will allow startups across the globe to do business and handle mobile payments efficiently, giving entrepreneurs more time to focus on growing successful businesses. Critical thinking questions. 1. Do you think Stripe's strategy of keeping things simple is a sound business plan? Explain your reasoning. 2. What impact do you think the company's Atlas product offering has on Stripe's global expansion? 3. Do you think Stripe's agility in working with so many different businesses provides the company with a competitive advantage over big banks and credit card companies? Justify your answer. This has been Introduction to Business, 2nd edition, from OpenStax. OpenStax textbooks and this free audiobook are covered under a Creative Commons license. The full text is available at www.openstax.org. You can find this free audiobook anywhere you listen to podcasts, including Spotify, YouTube, and Apple Podcasts. Instructors can even download a course shell to easily embed these recordings in Canvas courses. Learn more by visiting www.openaudio.us. Did you find this audiobook helpful? If so, please let us know by leaving a comment and sharing this recording with a colleague or a friend.